Hello everyone and welcome. I'm Mr. Tommy. Today we are diving headfirst into 2026, a year that's not being defined by just one trend, but by what you could call a great convergence, a set of massive forces all coming together and fundamentally rewriting the economic playbook. So let's break down what's really happening.
If you look at the market on any given day, things feel pretty resilient, right? Growth seems steady, maybe your portfolio is looking healthy. But here's the thing you have to understand. Don't let that surface calm fool you. Underneath it all, powerful, deep currents are shifting, and they're building up some serious tension that is rewriting the rules of investing as we speak.
So here's our game plan for the next few minutes. We're going to start with this new economic chapter we're all entering. Then we'll dig into the double-edged sword of AI, both the boom and the bubble risk. After that, we'll unpack this idea of the great fragmentation. Then we'll tackle the problem that just won't seem to go away, inflation. And finally, the most important part, we'll pull it all together to see what it all means for your investment strategy.
So what is this new chapter all about? Well, it's not just one thing. It's a powerful convergence of three distinct but totally interconnected forces. You've got the explosive rise of artificial intelligence, the fracturing of the global order, and the stubborn, sticky persistence of inflation.
And hey, don't just take my word for it. JP Morgan's 2026 outlook points to these exact same three things. They see artificial intelligence, fragmentation, and inflation as the very pillars of our new market reality. Now, all three are critical, but let's kick things off with the one generating the most excitement and maybe the most uncertainty: AI.
All right, let's talk about AI. It's so much more than a buzzword now. It is a genuine economic engine. It is driving a wave of investment and productivity that we really haven't seen in decades. But, and this is a big but, with any boom of this size, there's always that looming question of a bubble. Okay, this slide right here puts the whole AI boom into a really stunning historical context. Vanguard did an analysis comparing it to other huge, transformative buildouts. Think about the railroads in the 1840s or the telecom boom of the 90s. And what they found is just fascinating. Compared to those, today's AI investment cycle is really just getting started. We might only be 30 or 40% of the way up the mountain, which suggests this boom could have a long, long way to go.
And the scale of this thing, it's just staggering. $2.1 trillion. That's the amount of money major AI companies are expected to pour into capital investments between just 2025 and 2027. That's not a trickle of cash, my friends. That is a fire hose of capital being aimed squarely at building the infrastructure of our future.
So, with that kind of money flying around, you have to ask the question that's on everybody's mind. When does a genuinely revolutionary technology boom cross that line into a speculative bubble that's just doomed to burst?
History shows us that bubbles, whether it's dot-com mania or the railroad craze, they almost always follow the same script. It starts with a real paradigm shift, a belief the world is changing for good. Capital and credit pour in to build for that new future. But soon, valuations get completely disconnected from the fundamentals. The crowd rushes in with a fear of missing out, and well, the parallels to today's AI frenzy are becoming pretty hard to ignore. This is the critical risk we all have to watch.
Now, that risk gets even bigger when you layer in our second major force, the great fragmentation. The era of hyperglobalization where goods and capital just flowed freely to wherever was cheapest, that era is over. Today, geopolitics is redrawing the map, splitting the world into competing economic blocks and completely rerouting global supply chains.
And this isn't just some abstract theory. You can see it plain as day in the data. Just look at this shift in U.S. imports. In 2017, over a fifth of all goods coming into the U.S. were from China. Today, that share has been nearly cut in half. That chart, right there, is a picture of economic decoupling happening in real time.
So, why is this happening? Well, U.S. trade policy is a massive driver. This year alone, the effective tariff rate on Chinese goods shot up by 20%. But at the same time, look at the increases from Mexico and Canada. They're way lower. The goal here is pretty clear. Build a more resilient North American trading corridor.
What all of this really signals is a fundamental change in how we think about the economy. For decades, the entire global system was optimized for one thing: pure efficiency, making things at the lowest possible cost. That era is over. The new priority is resilience, building secure, reliable supply chains that you can count on, even if they cost a little more.
And that idea, costing more, leads us directly to our third major force, inflation. The idea that inflation was just this temporary, transitory problem is pretty much fading into the rearview mirror. There are a number of deep, structural factors that are coming together to make sure that the fight against rising prices is far from over.
There are really four key reasons for this. First, governments are running bigger deficits than they used to. Second, we have real shortages in key areas like housing and skilled labor.
Third, consumers are actually in pretty good shape. U.S. household net worth is up over 50% since before the pandemic, and that fuels demand. And fourth, as we just discussed, building resilient supply chains by onshoring is just inherently more expensive. All of these things are pushing prices up.
Okay, so let's recap. You've got a booming AI sector that might be a bubble, a world that's fracturing, and inflation that is proving to be incredibly sticky. So, the big question, the million-dollar question is, what does this actually mean for your money? How do you even begin to invest in this new era?
Let's start with a really big one. Vanguard's outlook is declaring loud and clear that bonds are back. Think about it. After years of getting paid basically nothing, higher interest rates mean that high-quality bonds now offer compelling real returns and a really crucial hedge against stock market risk. This is a fundamental shift in how we think about building a portfolio.
So let's try to build a potential toolkit based on what the experts are saying. Vanguard is highlighting high-quality U.S. bonds for stability and income. They also like U.S. value stocks, which are well-positioned to benefit as AI's influence spreads beyond just the big tech names. Then, to fight inflation, JP Morgan suggests things like real assets, gold, real estate, and commodities, which help you maintain your purchasing power. The common thread here is pretty clear. Quality, diversification, and a real defense against inflation are the new priorities.
Ultimately, navigating this new world requires a new map. The great convergence of AI, fragmentation, and inflation presents both incredible opportunities and some very significant risks. The crucial question for every single investor right now is, how will you adapt your strategy to find your path forward? Hey, if you enjoyed this breakdown and want to stay ahead of the curve, make sure you subscribe to the FinAnatomy channel. We're constantly diving deep into the powerful forces that are shaping our financial world, and we'd love to have you along for the ride. And finally, just a quick but very important disclaimer. The views we talked about here today are for informational purposes only. This is a reasoning exercise based on public sources, and it absolutely does not constitute investment advice. All investment decisions should be made by you, the individual, based on your own specific financial needs, your objectives, and your personal risk tolerance. Thanks for watching.